Our next panel on access to credit will be moderated by Christie DeSanctis, NAR's Director of Federal Banking, Lending, and Housing Finance Policy. Christie DeSanctis previously worked for the U.S. House of Representatives Committee on Education and the Workforce and the U.S. Senate Committee on Small Business and Entrepreneurship on Employer Benefits and Workforce Protections Matters. Christie is joined by panelists Lariece Monique Brown, Quantitative Analytics Director at Freddie Mac. Lariece leads a team that conducts analytics and research of underserved markets and has extensive experience in research to support fair lending, affordable lending, and assessing opportunities to expand access to credit. Ed Golding, Executive Director of MIT's Golub Center for Finance and Policy and a senior lecturer at the MIT Sloan School of Management. Ed was a former FHA commissioner where he helped formulate U.S. housing policy in the aftermath of the Great Recession. And Sara Rodriguez, CEO of Titan Title and principal partner at Mendez Rodriguez. Sara specializes on all matters related to residential and commercial real estate transactions. She also serves as part of the National Association of Hispanic Real Estate Professionals National Board and is the 2019 president-elect.
Well, thank you all. Thank you all for joining us here today. A year ago at this forum, we were discussing GSE reform, and a lot has happened in a year. A lot of progress has been made, but there's still a lot of work to be done. As Alana mentioned earlier, it has been exhausting. For example, did anyone think the Washington Nationals would win the World Series before the GSEs exited conservatorship? So while the Nats work on their second title, we continue to talk about the future of the GSEs, the liquidity in the market, and consumer access. There's still a lot of important policy decisions to be made. So to continue today's discussion on housing affordability, our panelists today are going to focus on access to credit. So we only have about 45 minutes to dive into that very small topic. So I think we're going to go ahead and get started. As we just heard, each of you have very unique experiences in this industry. If you could each just start telling us a little bit about what you've done to help increase access to credit, to help transition borrowers into home ownership, and specifically for those underserved borrowers. Sara, do you want to start us off?
Sure, absolutely. First of all, thank you for having me. It's a great honor to be here and talking about, like you said, a very small, but a little bit impactful issue. So as part of NARIP, which is the National Association of Hispanic Real Estate Professionals, we are a real estate trade organization, and our biggest asset is our members. They're real estate practitioners, where they are realtors, brokers, title companies such as myself, lenders, mortgage brokers, that deal with the consumers, specifically the Hispanic consumers, at the point of sale. So one of the biggest assets that we have and we leverage is using our membership by surveying them and finding out how these regulations that are coming down the pipelines are actually impacting the consumer. A lot of these regulations are there to protect the consumer, but unfortunately, if they are not conscious of all the cultural distinctions and the cultural nuances that are out there, they can end up impacting our demographic, Hispanic demographic, in a way that they didn't think about. So we do focus on education as well. We educate our real estate professionals so that they can in turn educate the Hispanic community as to financial literacy. But I think our biggest asset is being able to get that boots on the ground, real-time market intelligence about how things are truly impacting one of the biggest growing demographics in homeownership.
Thank you.
I want to pick up a little bit on a theme we heard this morning, but really sort of emphasize it from having been there on the inside. And I'm going to sort of say FHA squared. And there's two FHAs that I've been very involved with. The first one, of course, is the Federal Housing Administration. During my time there, about 2 years, we provided approximately 1 million households opportunity to get their first house. And when you look at communities of color, FHA is the source of about 2/3 of the financing for first-time home buyers. Very important institution, started in 1934. And we heard a little bit about Brian Montgomery's successes on the condo rule, on modernizing the claim process, and the like, and real kudos to his work doing that, continuing innovations that had been started over a decade ago. Actually, I think some of them started when Brian's during his first term there. Saw John Weicker in the audience. I think some of them may have even started with him. The thing is, FHA is underfunded. Things that literally take decades to get done should be done in months. There's no reason for a condo rule to languish for 10 years. And it was, quite frankly, just a relatively modest change. There's a lot more we could do on condos. So if I'm going to leave you with any one thing, it really is to fund FHA on that. The one stat I always use, there are 700 people in FHA single family. I'm not picking on my colleague at Freddie Mac, but I think you have about 7,000 on that, 10 times the number of people, and they can be much more innovative and faster. So if we're talking about access to credit, we really have to make sure that we truly modernize FHA. The other FHA that, I don't know why we had to reuse acronyms in Washington. The other FHA is the Fair Housing Act. And I was very glad to hear people stress the importance of the Fair Housing Act. It's very important that it's enforced. And when I think of access to credit, it's these, I know risk is very important, and we have very sophisticated automated underwriting tools to measure risk. And then by policy, we override those tools and put things like DTI cliffs and overrides on. And they all have disparate impact. In my mind, they all violate the Fair Housing Act, and I think we need to enforce it more vigorously. So those are my two FHAs that I would emphasize.
Great, Lariece.
Thank you. So I'm going to front load a lot of my comments today because I have a few data points that I would like to come at. First, thank you so much to the National Association of Realtors for inviting me today to speak on this panel. So where I sit, I'm on the data side. I work with the group that looks at data insights and analytics to bring information on the barriers as well as potential solutions to overcoming barriers to home ownership. Earlier today, you heard Alana and Donnell mention a few of the statistics that come out of some of the reports that we provide. And so I just want to give you a little bit more background because I think it would help kind of provide some color to the discussion and to the policy debates, which I can't personally wade much into very deeply, but can provide some statistics that may be useful for the conversation. So for instance, one of the things that we do is we look at a lot of research. We currently have a panel data that we're using to understand what some of the barriers to access to credit may actually be. And we look at things like what portion, the nice thing about our credit panel data, I should say, is it's a random sample of credit visibles who are not just mortgage holders. So this is very different from just the standard Freddie Mac data. It's who else is out there in the credit bureau data. And with that data, we've been able to identify things like 31 million mortgage-ready individuals under the age of 45. For instance, Alana gave us a related statistic broken down by race and ethnicity. And the way we approach this at Freddie Mac is looking at opportunities for how our products and services and the way the solutions that we offer to lenders can actually open up opportunities to expand access to credit. So with that 31 million mortgage-ready consumers out there, mortgage-ready from the perspective of what their credit profiles may actually look like in the credit bureau data, not a complete picture, we start to break down and try to understand, well, to what extent might that be driven by affordability or housing supply issues, for instance. And one thing we realized, Alana mentioned this earlier as well, we have to pay attention to the fact that when you have mortgage solutions out there that require 20% down payments, that may be more limiting to various groups of individuals who do not have access to equity transfers or wealth transfers from their families and may lead to additional disparities or differences between different race and ethnicity groups. So for instance, if you're looking to save 20% down, in our analysis, we're finding that for non-Hispanic whites, that can take about 14 years if they were left to save for a down payment without the assistance from their families and so forth, without any kind of transfer. And similar numbers for Black households, 15 years, for Hispanics, 25 years, and for Asians, 24 years, with the difference being living in more high-cost areas for Hispanics and Asians. That means that if you're not getting a wealth transfer, you're waiting, from, and this is for a group that's age 18 to 45, you could be waiting quite a while before you're able to afford your first home. If you change that to a 3% down payment option, you're looking at ranges from 2 to 4 years of time that is required to save for a down payment, even before you put any down payment assistance on the table, and that can really make a big difference for closing some of the gaps that we're talking about. So at Freddie Mac and the GSEs in general, we do have the lower down payment options out there with the Home Possible mortgage, for instance, for the low to moderate income borrower, allowing the 3% down with affordable second options and so forth as well with the nonprofits or the organizations. We have the Home One, which is for first-time home buyers where we do not have the income and geography restrictions even. That's been a very useful product, I believe, in the market as well. The Home Possible product is actually about almost nearly 80% of the people using the Home Possible product have been first-time home buyers actually. And with our Home Possible product for first-time home buyers, we're also requiring home buyer education as part of that. We view that as another pillar based on research we've conducted in the housing, education, and counseling space. So that's required as part of that project with the initiative for Home Possible as well. I can go on, but I'll pause there and come back with more later.
Well, thank you. Those are incredible statistics, and I think it drives home a lot of the points we want to make is making sure there's enough options out there that are available. All of us in the room, I think we can generally say there's concerns about the direction of where the future of the market's going to be, what's going to happen with the GSEs. We know that the director has made comments that a large portion of the market could be shifted into that FHA market, and what could that do to both? How can each maintain stability while ensuring there's no gaps for consumers, that there's still access to credit, and more importantly, no higher costs? So Ed, actually I'm going to turn to you to see if you can address that a little bit about any concerns. You just mentioned underfunding of FHA.
Yeah, so I'm one of the few people here who almost remember the 1950s. I like to look at a long series of history, and in many ways, the government has always, in modern times, been heavily involved in mortgage finance. If you go back to the 1950s, FHA VA, when my father wanted to buy his first house, it was done through a government program. Market share of the government's footprint was 50, 60, 70% during that period. And somehow we think of those as the good old days, or at least there were some good aspects to it. We left a lot of communities out, but we had a government footprint in that period, and people really don't criticize that as too much government. So it's always a question of what do we want the government role to be in housing. I think that we need to have that discussion. People will differ. It's not surprisingly, I might differ with this administration on what that role is. But I think it is good to look at a long time series. Also, I'd mentioned, we had an S&L, savings and loan was a way of producing housing finance. That system cost us $200 billion of a check that the government had a right to bail out the deposit insurance behind savings and loans. FHA and VA have never had a government outlay. It's important to keep that in mind. But if you really do want to shrink, if the policy goal, elections have consequences, if the policy goal is to shrink the footprint, I think you really should start off in the sectors that don't need the support. It's the second homes. It's about, I think, 4% of GSE purchases are the second homes. That's something the private sector could do. You could tomorrow raise the price, the LLPAs, the loan level price adjustments. You could raise those by 5 points, and the private sector would basically step in. The super conforming. So if you're going to really lower the footprint, which wouldn't be my top priority, but if you're going to do it, don't do it in the areas that affect the people who have been disadvantaged for so long by the housing finance system. Go ahead and do it on second homes or near jumbo loans would be my thoughts.
Sara, do you want to comment specifically on what you're seeing on the ground following that?
I mean, I think I agree 100% with what he's saying. We're seeing that just, it's incredible to me. We were talking about this earlier, that we're still talking about this issue. And we see the statistics that are saying, hey, there is how many people that are mortgage ready. This means that people that are being looked at that could actually buy a home but are not being able to buy a home because they can't afford it. They can't afford it, why? Well, they can't afford it because, obviously there's low inventory, but also because they don't have access to credit. And access to credit, a lot has to do with not being able to save for that down payment. I mean, I can tell you myself, went to law school, did all the right things that everybody's supposed to do, and we were able to buy our first home because we were under a VA. And we didn't have to save all this money to be able to buy our first home. So that was a great opportunity for us. If you look at the Hispanic community and other minorities, we do concentrate a lot in these higher price metro areas, and it's a little harder to save money to be able to save for that down payment. So absolutely, I think that, I see a lot of people coming through my table that have the money, could qualify, but because of one thing or another are just not being able to get to the next level. So we're going to be talking about DTI and the QM patch, and I have a great story on that would drive the point home when we get to that.
Great. Well, we can transition to that unless Lariece, you want to make a comment?
I do have a comment. So, the government sectors there. I do want to point out that the GSEs actually have the largest mandate in terms of affordable housing. We have the affordable housing goals and the duty to serve underserved markets. I didn't get a chance to touch on that, so I really want to make sure that I point out our duty to serve underserved markets, which goes beyond just the kind of what people may typically think of as the affordable goal mandate. In terms of the low to moderate income borrower. For the underserved market, we've put a lot of time, effort in terms of research and trying to identify product development opportunities in underserved markets as well in terms of expanding access to credit. So the administration or whoever has decided that this was all part of the Housing and Economic Recovery Act actually of 2008. So we've expanded in manufactured housing, rural markets, and affordable housing preservation, which includes the shared equity, community land trust, as well as the energy efficiency space.
Great, thank you. So transitioning a bit, so we know earlier today Director Kraeringer was testifying for the House Financial Services Committee, and we're assuming she took questions based on her letter that outlined the Bureau's planned action for the qualified mortgage rule. Most details weren't included in that. We're going to wait to see those in the NPRM later this spring, but we did know she mentioned including extension of the QM patch, replacement of the DTI ratio calculation, alterations to Appendix Q, and also those compensating factors to incorporate into GSE's underwriting systems. So starting broadly, how and what changes should the CFPB implement to avoid disruption in the marketplace and ensure those credit-worthy borrowers, those mortgage-ready folks, continue to have access? What risks could arise with inaction? Ed, do you want to start us off on this one? Or pass?
Sure, I'll start. So we were cautiously optimistic when we heard the direction that this was going. At NAR, this was one of our top priorities last year. We were part of this coalition to advocate for, of course, the extending the QM patch as well as getting rid of Appendix Q and getting rid of or moving away from the DTI. We, of course, want to make sure, and we're looking forward to seeing how it's going to change, but we want to make sure that they're taking into consideration all the cultural nuances of how the Hispanic market, which is going to comprise one of the highest, in the growth out there. I told them, I'm not good at statistics, so I wrote them down, but we are, one of the highest in growth for the homeownership, and we grew last year 47.5, and that's the 5th consecutive year of growth in homeownership. So that's something really fantastic, considering that that growth hasn't been that big in other demographics. So one of the things we, of course, want to make sure that we're maintaining safe products, But we want to make sure that they take into consideration, like I said, these cultural nuances. One of these things, if the CFPB moves forward towards the pricing model versus the DTI, we do want them to consider looking at raising that spread for QM loans instead of 1.5 or 150 to 200. If you look at the data that is out there, we look at the data from HDMA for in 2018, it showed that if you take out the borrowers that would qualify within that 1.5 to 2, you actually are hitting disproportionately the Hispanic market and the African American market more than anybody else. Now, for a practitioner such as myself, sometimes we were talking like, okay, what does that mean, right? How is that, how am I gonna be able to see that out there in the market? Well, I was telling them the other day, I had a closing in my office. It was about a month ago. This nanny for a high-priced power attorney in DC. Now, she had been working for this DC attorney for 5 years. Okay, we all know the hours that we work here in DC. Whatever job you do, you know that you're working 100 hours a week, right? So this nanny had a contract for a certain amount of hours, because we all, of course, you write in our contracts the minimum to make sure that's the minimum that we have to pay, right? But, you know, she was making overtime, and she had been making overtime for the last 5 years, because that's just the hours that they're paying. But the underwriter, even though she had enough money, she was making enough money, the underwriter didn't like the fact that a lot of that came as overtime, and it wasn't in their contract. So we had this babysitter who was making a really good salary and had been for the last 5 years, that could prove that she had been paying all her debt, all her rent, all this other stuff, and she didn't qualify. And she wasn't able to close on her home because she didn't have a contract that stated that she made this amount of money every year, even though she could prove that for the last 5 years she had been able to do this. Now, these are things, you know, when you take a look at the Hispanic community and a lot of, you know, and the African American community, you start seeing that, and to be honest, even the millennials, you start seeing that we treat work, we're very entrepreneurial by nature. And we have one of the highest numbers and demographics of working in the gig economy, right? Uber drivers and, you know, having all these other types of how you create your money and how you do business. And yet we're looking at them with DTI ratios from, you know, a decade ago or even further. So it's a little bit, that is something that we can easily do and change. That is not going to create more home ownership for people who can't afford it, but we can actually mirror the way that we're doing business with the way that we are doing business here.
Thank you. And actually, just following up on that, so some of the things you mentioned over time, these sound like other factors that should be taken into consideration. It sounds like maybe with the pricing model, that's not always the case, including those factors, and how the pricing model maybe doesn't risk assess in the same way it would for, say, a more dynamic measure. If you want to talk a little bit more kind of the alternative to the pricing model.
Yeah, I'm going to still highlight how pernicious DTI is. It should never have been allowed into this housing finance system. First, two observations. First of all, there are a lot of low-income renters who pay over 50%. So we don't always look at the alternative. If they're paying over 50% of your income to rent, why shouldn't you be able to do that and own the house and build up equity? Work up by the Urban Institute basically shows that if you change DTI by 10 percentage points, it's a 0.5% change in default rate. Compared to, say, a 100-point change in FICO, the change in the default rate is 10 times that. So DTI is not a good risk measurement. And it really is, if you go back away from the data and to the stories on who is having a high measured DTI, you know, it's the nanny, it's the person who's getting contributions from grandparents who are living in the household, extended families, often, you know, again, protected classes who are getting harmed by these measures, but everyone. It's the recently divorced family where they want to keep the child in the same school district, but because you're divorced now and there's only one person on the mortgage, all of a sudden your DTI doubles. It's the retiree who wants to move. So, let's look past the data. And, these really are our family members who are, just not quite cookie cutter. And we shouldn't be doing overrides. We have very sophisticated automated underwriting systems. DTI is in there. It's the overriding of the automated underwriting systems and all the big data and the AI that fintech is bringing to us, and we're overriding it either based on our own biases, biases, or by policy. And we shouldn't be doing that. We should be allowing for innovation. We should be allowing for new entry to use the big data. That's not to say big data doesn't need to be overseen under fair housing. Their biases can move into that. But I think some of these, overrides have been really very harmful. One last thing, what needs to be done going forward? A little bit out of the box, but I would actually go back and rewrite the QM in Dodd-Frank and get rid of the need to set a maximum default rate, which is really what they're trying to do. Short of that, the federal regulators could basically approve automated underwriting systems. Freddie Mac is a very good one for LP, or whatever you call it nowadays.
I was going to mention that, yes.
On that, but why not have any new entrant come and have their automated underwriting system approved from a QM perspective? If we're not going to go that route, and we probably won't, because I know Washington, we need to keep it simple and available to all. So a simple interest rate measure, similar to what we do for HOPA, but also recognizing that small loans need a bigger cushion, is probably the way to go. You want competition, you want it open to all, and you want it to be simple if you're not going to do sort of major reforms in QM.
Yes, thank you. Thank you for the lead-in to what comments I did want to make on this point. So within Freddie Mac, we definitely look at more than one particular factor when thinking about our underwriting systems and modeling decisioning models, for instance. And we'll continue to do that. We're still innovating. We're definitely in conversations with FHFA about how we think about credit risk. The objective is to accurately measure risk or assess risk to the extent we can, while, when we do that, we're able to put people into a home ownership situation that's sustainable, right? We want to put people into a sustainable home ownership, where they can afford it, where it makes sense for them, where the risk is within the tolerance that we're willing to accept at that point in time. Sara, your story at the beginning of this conversation really struck a chord with me, and I'll take that back, and because we're constantly looking for opportunities to continue innovating in the way that we think about how we measure income and assets. That's one thing we've definitely been focusing on. For instance, I think last year we released we have this automated. This kind of automated income and asset modeler, this AIM thing, where we look at, we revised it for self-employed people, where for self-employed individuals we can use the OCR, or the kind of an optical scanning technique, to pull information off of tax returns, for instance, to make it more seamless to be able to look at the income and assets for self-employed individuals. So I think there may be some additional opportunities to continue to innovate in this space for people in the gig economy as well as self-employed individuals. So I really appreciate that story, that narrative. Thank you.
Great, thank you. And you mentioned changes to Appendix Q. We know that's something the director is interested in doing. Is it practical to just eliminate Appendix Q? It sounds like we need to be updating it and taking into consideration these independent contractors and all these alternative means to bring income. What are your thoughts on just scrapping it completely?
Well, I think I would scrap it completely. You should let, whether you call it fintech, big data, or just normal, innovation that occurs within financial firms, you should allow the technology to decide who gets credit. And you should have enough competition so that it's not just one person or one firm's credit decision that dictates who gets credit. These are, in the parlance of economists, these are very insurable risks. There's a lot of capital out there willing to support this. We just have to give them access to the housing finance system. And what we're doing is we're creating barriers to entry. And here's where I think we need more competition, more innovation. As I understand, Appendix Q was somebody picked up FHA's handbook from 20 years ago and decided to try to incorporate it. And and now 10 years later, we're trying to change it. That's not the role for government. There should be protections. The most important thing Dodd-Frank did was they got rid of bad products, right? I always we knew at the time that something called a liar's loan probably wasn't a good product. It didn't take a lot of regulation, but Dodd-Frank did some very important things. They got rid of really bad, products out there. But trying to regulate, what they call sustainability, maximum default rates, and trying to put into regulation how to do the underwriting process, I just think was a mistake. And so this is one area where I would like to see more deregulation, but with a lot of strong consumer protection still.
I think everyone can agree with the consumer protections piece here. We don't want to have a repeat of what's happened before. Transitioning a little bit to some of the barriers to entry that you mentioned, liquid reserves, including access to checking accounts, savings accounts. We know there's a lot of disparities across populations and geographies in terms of the availability of traditional banks and financial educations, which obviously impacts consumers' banking relationships and credit. So how do we address some of these obstacles that inhibit wealth building and transitioning into homeownership? I know you mentioned your 47% rate of Hispanics, homeownership rate, trying to get to that 50% mark. I know it's been a goal for you all for a while. It sounds like it's getting closer. So what are some of the things you all are focusing on in terms of getting that strong banking relationship?
So one of the things is we have to understand the Hispanic community, right? So we've been talking today here, do we get rid of this? Do we change it? What do we do? Do we tweak it? And one of the things that I think we all need to keep in mind when we're dealing with these issues is that there's not gonna be one perfect answer if we just draw a line on the sand, right? Because generations that are coming down from us, they don't work like that. They don't think like that. There's just too much change and too much innovation and too much entrepreneurial spirit out there to be able to draw that line in the sand. So when we understand the Hispanic community, we understand that they are huge self-employed people, big entrepreneurial spirit. I was looking at the statistics that said that even though most businesses are kind of shrinking, Latino-owned businesses are actually doubling. There's, twice as many Latino businesses as there were, and that's one of the biggest growth that we're seeing. On the same token, we're also seeing that there are 31% of Latinos are participating in the gig economy, which is kind of like silent when it comes to credit scoring or all this stuff. So that's where we're really growing, but at the same time, we can't use that to be able to show anything. Another part of the Latino community that we have to understand is that, yes, we are a cash mostly only community. I was laughing because I was saying, even my parents, they don't keep the money in the mattress, but they do keep it in a safe box. And I'm always like, Mom, why don't you put it in the bank? Like they go out and they pay everything cash. Like in a lot of the Hispanic community, they have this mentality of wanting to pay everything cash. We see so many of my home buyers that started working with their lenders where they had, they've been paying rent for a long time, they've been, paying their taxes, all this thing. They have their own businesses, but they would take their money, cash the checks, and then pay all their bills. Well, now they've become part of this 29 million Americans who are kind of like credit invisible or credit thin, what we call them. So I think in part is on one side, we have to be a little bit better about educating the consumers on financial literacy and kind of how to play the game, for lack of a better word. At NARIP, we are doing a lot of that. We have some courses that we've developed that are the Certified NARIP Trainer, that we go out into our communities, whether they are in churches or schools, to try to teach about financial literacy and why it's important to have credit and how do you use credit and why you should pay with this and then pay it off. On the other hand, I think it's very important because education is going to take time. And what we don't want is, on one hand, we want to protect the consumer, because none of us want what happened a few years ago, where especially the Hispanic community was, they were devastated with the housing crisis. So on one side, we want to protect the consumer, but on the other side, when we're bringing regulations that protect the consumer but don't understand the consumer, we are actually impacting them in a different way. I mean, I remember as doing closings where when the law changed and now you have to have your documents 3 days before closing and you can't change. Well, that sounds great in theory. That's phenomenal. Everybody wants to know what they have to bring to the table 3 days before closing. And then what happens? The seller didn't do this, the house did that, they need closing cost credit or something needs to be fixed, that changes your IPR, so now you can't close. And now you have people who either close with something that's not going well, which is not what the law intended at all, or you don't close and that can cause financial issues. So I just think that, yes, we do need to have an education piece to what we're doing, but at the same time, we kind of need to move both things forward. We are educating our communities, but we also have to put things in place that are going to help kind of bring our communities and close that gap that we're seeing.
Okay, thank you. Very, very interesting question, very important discussion. And I want to touch it because a lot of people do not realize what role Freddie Mac is trying to play in the community for understanding some of these additional issues that you point out and how we're trying to tackle the problem. Obviously, our primary business is working with lenders, providing solutions to help them deliver loans into the secondary market. But we also realize if we want to expand access to credit and deal with things like the minority homeownership gap, that we have to go more boots on the ground as well. So we've adopted or partnered with many borrower help centers. We have a Freddie Mac borrower help center network across the country. Our latest one is actually in Macomb, Mississippi, for instance, to help us get closer to the rural markets that we're interested in. The FDIC does a biannual survey of unbanked and underbanked to determine what portion of households in the United States are unbanked and underbanked, to get back to your kind of liquidity and access to checking and savings accounts issues. Recently, I think the latest report they put out said that between 6.5% and 7% of US households are actually unbanked, meaning they do not have an actual checking or savings account with a bank or a credit union. And that percentage is really high for metro areas, but it's also high for, disproportionately high for rural areas. In the rural markets, that number goes up to about 7.5% unbanked. It's higher also for African Americans, and they also go through and try to figure out what are some of the reasons why we see such a high unbanked rate for African Americans as well as Hispanics. For African Americans in particular, they're finding issues of kind of distrust, in addition to saying that they do not have enough, or feeling that you do not have enough to actually sustain an account. So we're paying attention to that type of information. The other piece of it is, even if you have an account, we've talked about the credit visible piece. We have to pay attention to that. We're looking at clean, thin files. There's actually a large population of individuals with clean, what we call clean, thin files, people who do not have delinquencies in their credit profile, but actually they are essentially unscorable because of a lack of trade lines. So we're starting to see if we can get a better read and a better handle on that. But through the borrower help centers, we're also promoting the use of credit responsibly, saying if we can connect individuals with the appropriate accounts, if that's the next necessary step for them as well.
I just, quickly, I want to go back to something that Jim Park said. Work that I did at Urban with a co-author, Sara, showed, to my surprise, just how important limited English proficiency is in explaining homeownership gap. Now, I'm not saying there's causality there or that we understand the causality. There's lots that could be going on. But in communities where there's more limited English proficiency, you see an unexplained reduction in the homeownership rate. And so we need to work on that. And I think that is really affecting the Asian community, the Latino community, and the like. And so Jim highlighted that. I want to pick up on that because the research does suggest that there's a barrier there that we don't understand. Also want to highlight the role of housing counseling. HUD supports and certifies housing counselors, but there's more that can be done. There's been improvements, but the funding is going down, and even though the whole system benefits from housing counseling, no one really wants to pay for it. Sort of a tragedy of the commons. So we have to worry about the the funding of the housing counseling agencies. So those, I think, are the two issues that I would highlight.
But I think you bring a great point when you're talking about the language proficiency, because sometimes it's not just necessarily about the language proficiency, but also understanding how the different communities and demographics feel about money or think about money. I know in the Hispanic community, it's taking a lot to educate and to be able to even talk about money, because it's a kind of like a taboo subject. You don't talk about money. That's something that you don't speak on. You can talk about politics, you can talk about religion, but you don't talk about money. That's how the Hispanic community is. So bringing that, it's not only about being able to speak Spanish, but understanding those different nuances as to how do you speak about money? How do you approach that financial literacy? How are we teaching people? If you are, focusing on educating the consumer so that we can be a little bit more financial have more financial literacy, so that then we can go ahead and get more access to credit, you have to understand that it's not only speaking the language, but also understanding how you're talking to them. If you are preaching at them, or if you're collaborating and sharing a different way of doing it. So I think that's something that we can take a look at as well. And the housing counselors definitely bring a lot to that. Also understanding about multi-generational households, which in a lot of the minority communities, we're very big into families. So it's very normal to have parents or siblings that are all in one household, and they're all contributing to this one pot to be able to afford this house. So.
Well, it sounds like there's a lot of education being done on behalf of your groups and on behalf of ARIA and NAREB that we heard earlier. You just mentioned housing counseling. What else can the lenders be doing in this case? We know they're looking at updates to the Community Reinvestment Act. Should credit be given for offering some of these programs? Is that something that would kind of help drive this as well? Any thoughts on that? Or we're just going to see what happens? Wow, silence. All right. Interesting. Finally stumped them. It took 45 minutes, 40 minutes.
I'm going to start so I can not dig myself into a hole right away.
Understood.
So CRA is an interesting question to pose for me, because as the GSEs, with our affordable housing mandates, the duty to serve underserved markets, we're certainly paying attention to the conversation. And staying at the appropriate distance and allowing the various regulators to work through whatever they need to do and so forth. It's interesting that there's a proposal for allowing more rural Indian country things. It seems like there might be some things consistent with the duty to serve underserved markets. We'll stay tuned, and we're interested to see how that all comes out.
All right, so.
I'll get myself into trouble here, but that's okay. I spend 3 weeks a month up at MIT, and the technology and what's going on, you say they're underbanked, but we still have, almost everyone now has a cell phone. The world 20 years from now is going to look very different. CRA in particular, strikes me as just backward looking to something that made sense in the 1970s and 80s. We should start with a clean sheet of paper and say, how do we open up finance to a modern era? Other countries are doing it. Fascinating things going on in other countries. CRA just strikes me as still stuck in that brick and mortar bank, and how do we deal with it? I think we need to start over on some of these things. The body politic doesn't like to start over, and I understand that too. But boy, it would sure be nice to start over on some of these issues.
Great. Well, we'll stay tuned. We just have a couple minutes left. Maybe we'll just do kind of final thoughts, any last takeaways, things you're working on or looking forward to next.
So we're, cautiously optimistic, like I said, about what's coming down the pipelines. We feel that CFPP should definitely be working with trade group organizations such as NARIP in order to kind of have that boots in the ground, real life market intelligence of what the unintended consequences are with these regulations that are supposed to go. A lot of the times, theoretically, some rules might seem like a great idea to protect certain communities, but when you put them into action, they might have some actual devastating consequences. We talked today a lot about what can be done, or should we do this, or should we do that, but we have some real life things that we can do right now to be able to help a lot of the Hispanic population that is coming up the pipelines. And if you take a look at it into perspective, if we're thinking that the Hispanic population is the one that has had continuous growth through the last 5 years, and we are going to be 56% of the market in the next couple of years, we really need to start looking at what can we do to deal with these self-employed people with multi-generational households that are looking and using money in a different way. And I think that there is a way to do it without having to, complicate the issue too much. There are certain things that we can do right now to be able to take care of that large part of the population that wants to buy. They believe in home ownership. And that, I think, if we don't take that into account, it can have a huge detrimental impact in our economy in the next couple of years.
Absolutely. Thank you.
I'm just going to go back to where I started. Technology needs to be brought into FHA. FHA is still the predominant source of first-time home ownership, especially for these communities, and they need to be funded with modern technology.
And I'll just end with a little bit more of a positive tone. I'm excited about the opportunity to continue to innovate. We're looking forward to doing more innovation in housing this year. We're actually working very closely right now, looking at partnerships to get a little bit closer to specific communities, forming partnerships to innovate in housing, including housing supply. We're very interested in the role that manufactured housing can play in housing supply, energy efficiency for affordable housing, as well as the more localized solutions. That's one thing we're going to focus on this year, getting more, we can do our thing here in DC and McLean, and we want to go into the various communities that we really want to make a difference in this year.
Well, thank you all. We look forward to seeing the progress with all of this, and thank you for your comments, and I continue these discussions as we go throughout the rest of the day. Round of applause for our panelists.